Hello, everyone. Greg Towner here with Parallel Portfolios. Thank you for joining us for our monthly video. This month, we want to answer what should investors be doing right now? Obviously, a lot going on in the market, a lot going on in the world. Volatility has picked up, so we want to help you know what, if anything, should you be doing now? So let's start out by taking a look, as we usually do, at the broader market. This blue line is the S&P 500, looking back over 3 years. And we can see now just recently, for the first time in a while, since going back to the COVID lows, that we've broken below the 200-day moving average. So obviously the sustained uptrend that we've been in for quite a while has ended, or at least taken a pause. We're in a little bit of a downtrend. Obviously, volatility has picked up. You may recall last month, we looked at a longer term chart. We talked about how after long periods of sustained uptrends, a lot of times the market has to go through a period of sideways trading, some downside trading. It's not just resolved in downside price activity, but you also need to have a certain amount of time that goes by. So we think we're in that period now. How long it will be, how much more downside there may or may not have to be, obviously is difficult to say. What we do know is that there's already been a lot of damage done. So this is a look at a number of different assets, just year to date, just so far this year. You can really see the only thing that's held up well is commodities. Obviously, that's a good part of the inflation story. But if you look at all these other different asset classes, the broader market, if you look at the S&P 500, down around 16%, small caps down more than 18%. I mean, even bonds, those that are supposed to be adding stability to portfolios, unusually have actually declined. A broad bond index is down more than 10%. If we go down to the worst area, the high growth, more speculative technology areas of the market, down more than 50%, almost 55% just this year. So obviously, a lot of damage has been done. Now, that's reflected, as you might expect, in a lot of sentiment measures. We've looked at a lot of investor sentiment over time. That's negative right now. This looks at the US Consumer Sentiment Index. And we can see that we're nearing the lows that we've seen at other major points over time. This goes all the way back to the early 1980s here. This was a major market low when sentiment was so bad. We look at other low points. This is around the financial crisis period, major low point in stocks. So we're not necessarily saying that we have to have a major low in stocks anytime soon because the sentiment is low. It can get worse. You usually need a catalyst more than just sentiment to move higher. But what we are saying is that sometimes you have to remember that surprises happen in both directions. And when sentiment is so negative, a lot of times those surprises can be to the upside. When that will be, what exactly will be that surprise, nobody knows for sure, but something to keep in mind. Surprises do happen in both directions. So a lot going on in the market, a lot of negative things happening, as we just showed, but there's always opportunities out there. We're always looking for opportunities in portfolios. So this is a long-term chart going back to the mid-1990s. It looks at value stocks compared to growth stocks. And as you may recall, in the tech bubble, all the growth technology names are going up. So the value names were underperforming here. But then coming out of the tech bubble, value had a terrific run for 7, 8 years. It was a strong performer. Now, in more recent years, in the last 10 or 12 years, obviously growth has dominated. We've seen that repeatedly. But now more recently, we've seen that start to bottom out. We've even seen value have a surge here in the last handful of months. Is this starting a new trend? Is it going to be like this? Of course, we don't know, but we're trying to stay open-minded to that. And if that's the case, I think it will work well for us. We like value, we like quality, we like areas that are generating cash flow and dividends. So there's at least a possibility that value is going to go on a multi-year run here, at least relative to the growth areas of the market. So that's something that we're really keying in on at this time. Okay, so let's get back to the original question. What should investors be doing right now? You've certainly heard us talk over the years about avoiding the noise, right? That the financial news media and all of that, they're really just there to entertain you. I often tell investors, 2 of the things that you can do are never turn on financial news at any reason. And then also, believe it or not, only look at your account once per year when you sit down for your annual review with your advisor. A lot of people find that amazing. They're looking at it every day or multiple times per day. But for the stress that causes, particularly during challenging periods, the less you look at it and the less you deal with the noise, the better. Obviously, we always want you to focus on your long-term financial plan. And you know that we believe strongly in a disciplined investing process. For us, that revolves around quality, risk management, diversification. You want to have a process that you can believe in, and that way you can stick with it through good times as well as bad. Now, if you're still of age where you're working and you're able to save and invest, this is a great period to be dollar cost averaging, contributing every paycheck or every month or every quarter. Trying to time the market is very difficult. You may say, oh, I'd love to wait and put my money to work at the lows. Well, when the market's at a low, things are going to feel really bad, even worse than they feel now, perhaps. And you're not going to want to put money to work then because things feel so bad. So to smooth returns, dollar cost average in over time, you're really going to feel the benefit of that eventually when things turn around. Now, if you are a retiree, you may not have the advantage of that time aspect. So it's important from that perspective to have some level of cash savings to meet your expenses for a given period of time, so that you're not trying to or having to sell stocks to meet those immediate expenses. You want to be able to sell them when they've recovered to some extent. So get with us. We can talk to you about how much and how much a long period that you need to save for in cash. And finally, if all else fails, you just cannot handle the volatility, it's causing you sleepless nights, too much stress, perhaps it's time for us to sit down with you again and talk about your asset allocation, not just from a market timing perspective, but more from a permanent perspective. I mean, we always try to judge what appropriate asset allocation is, what our investors' risk tolerance is. But that changes over time, and we learn more, and investors learn more about themselves as things evolve. Things change in their life, they get older. Sometimes that allocation needs to be changed. It's important for us to keep an eye on that and change if we need to. So as always, please don't hesitate to reach out to us. We're happy to help you. Thank you. See you next month.